Paul Hickey is the co-founder of Bespoke Investment Group, and he is here with us. So is the worst over?
You know, I think the worst of the shock is probably over. What you tend to see during these periods is, we've seen massive dislocations in the market. We saw one of the fastest declines from an all-time high on record. There's only 6 that are even in the same ballpark. We saw the VIX surge above 60. That's unheard of. We've seen, the credit markets really go bananas last week, causing some to say that the U.S. is losing its reserve currency status and treasuries are no longer favored, which I think is completely unfounded at this point. You can't base it on 2 days. So, and today what we saw is normally when we see a tariff headline in the morning, like China saying they're going to halt deliveries of Boeing, that would have caused a pretty decent
sell-off, yeah.
Maybe not, but yeah, a pretty decent sell-off. And futures sold off a little bit, but they've recovered a bit since then. And so I think what you want to watch for is when you start to see less negative reactions to these headlines, which previously caused much bigger shock value in the headlines. And so,
could it be that the skies are clearing enough that, to Joe's point earlier, we can start talking about, kind of the best case scenario? You get it. You get less tariffs, or you get a little bit more kind of reshoring in some way, shape, or form. Maybe you don't get the recession that we thought was, a slam dunk a week ago.
Well, yeah, I think what we've seen in the last 6 months is after the election, we saw the pendulum shift all the way, saying Trump 2.0 is going to be all the good and none of the necessarily bad. Now it's swung the entire opposite direction, where it's only bad and nothing good. So I think we have to get into a more middle ground here. And, I think that's what we'll start to see. We're starting to see, the tax bill move through Congress. So that's positive. And I think the regulatory environment, that will come back. But the tariffs here, we're starting to see less of an impact from it. But we need clear messaging. Like, it's tax day right now. Can you imagine we've all just done our taxes, but then today you find out, okay, you're paying a different tax rate. Okay, like that's almost what it is. And taxes are at least on profits, and tariffs are on, you pay them no matter what, whether you're profitable or not. So I think it's a very tough environment for companies. But again, expectations have come way in. I don't think you've probably had a guest on in the last month that's expecting a positive earnings season. And a recession seems to be a foregone conclusion at this point. So I think the bar's been set low. We've seen estimates come in a decent amount on companies in the S&P 1500. And we haven't seen the data as far as jobless claims show an uptick. So until we see jobless claims, if we start to see a rise in jobless claims, that would be a concern.
So you mentioned you're kind of skeptical of this whole, people like sell America, fleeing assets, and that whole thing. But what is the significance? So then weaker dollar normally would be supportive for the markets, right? Or the level of bond yields, like, is that itself remaining worrisome? Like, how do all these pieces fit together?
Well, so like the dollar index, you were talking earlier, it's near a 3-year low, but it was also at this level last October. And the 10-year Treasury yield is where it was in February. So, I mean, we haven't seen these major moves. And I think what we've seen in the last week was major deleveraging from hedge funds. So I think that's more.
I think, Paul, it wasn't even February. It was like 4.3. It was at 4. I'm looking at it. 4.8 in January. Then in February, it was between 4.4 and 4.6. Then by March, it was down to 4.2.
Right.
And then it briefly got under 4. And now it's back to 4.38.
Yes.
I mean, I've heard people call it a historic rout in bonds, the 4.38. That's just...
You just wonder what they're looking at.
Well, no, that's just, I don't know what that is.
I mean, I think everyone has, everyone has a motive and an agenda.
Right.
But you think about the volatility in the long-term Treasury market is about the highest we've seen. A similar period was in August 2011. What happened in August 2011? The U.S. had its debt downgraded, and everyone was talking about how everyone's going to flee U.S. assets. Well, that was 14 years ago, and now we're still having this debate against, the premium or the, is U.S. brand America losing its luster, and it hasn't yet, and it could, but I wouldn't take 3 days last week during one of the most major dislocations in decades to say that's the case.